Between retirement and age 73, most people are sitting on a tax planning window they don't even know that they have and quietly letting it close. Hi, I'm Mark Wisniewski, president of Southern Incomes. I work with retirees on exactly this kind of thing. And what I see over and over is people doing everything right by conventional standards, saving diligently, leaving their IRAs alone to grow, and then getting blindsided at 73 when those required minimum distributions arrive and the tax bill is much larger than they ever expected. The problem isn't what they did, it's what they didn't do in the years before RMDs started. I think there are three strategies that can meaningfully reduce what you'll owe once those distributions are forced upon you. All three require starting before 73. After that, your options really shrink considerably. The first is Roth conversions, and this is where, well, I'd say most of the real opportunity lives. Every dollar sitting in a traditional IRA right now is a future tax bill. You just don't know yet what rate you're going to pay on it because you don't know what tax rates will look like when the government starts forcing you to take money out. What you do know is what rates are right now. And for a lot of retirees in their early 60s, those rates are unusually low. Here's why. You retire at 62, but hold off on Social Security until 67 or even to 70, you've got a gap. Several years where your taxable income is going to be lower than it's ever going to be again. That gap is opportunity. A married couple filing jointly in 2026 can have up to roughly $100,800 in taxable income and stay in the 12% bracket. If you're not filling that bracket in your early retirement years, you're leaving cheap tax capacity unused. And you may pay for it later on if RMDs stack on top of your Social Security and push more income into those higher tax brackets. The math on this is worth seeing. Say you've got $800,000 in a traditional IRA at age 62. Leave it alone. Let it grow at, we'll say, 6% annually. And by 73, you're looking at roughly $1.5 million. Your first RMD, based on the uniform lifetime table, would be around $57,000. All taxable, all landing on top of whatever else you're receiving that year. Now, let's run the alternative. Convert $50,000 a year from 62 to age 72. You have just moved $550,000 into a Roth where it grows without any future tax consequences and never appears on your RMD calculation. Your traditional IRA balance at 73 is substantially lower than it otherwise would have been, and so are your required distributions. If you're watching this and you're realizing you have never actually mapped out what your IRA balance looks like at age 73, or more importantly, what your first RMD is going to be, that is worth figuring out before that window closes. Book a call with me and we'll run through those numbers together. The link is in the description below. The second strategy tends to go against the default advice, which is usually to spend taxable accounts first, then pre-tax, and Roths last. That sequence, well, it sounds logical. The problem is it often leaves you with a massive traditional IRA balance right at 73, just when Social Security is maxed out and you have the least room to maneuver. What works better for a lot of people is pulling from pre-tax accounts earlier and intentionally, even when you do not need the money. If you're in the 12% bracket and have room for another $30,000 before crossing into the 22% bracket, take the $30,000 from your IRA, pay the tax, reinvest the rest in a taxable account. You have just permanently reduced the balance that generates your future RMDs, and you paid a known rate to do it rather than an unknown rate later in the future. I hear one objection to this constantly, that taking money out early means losing tax-deferred growth. But tax-deferred is not the same as tax-free. If your account doubles between now and 73, your tax bill doubles with it. The question was really never whether you'd pay taxes on that money, it's when and at what rate. The third strategy is qualified charitable distributions. And if you give to a charity at all, this one is worth understanding carefully. Starting at 70 and a half, you can transfer up to $111,000 per year directly from your IRA to a qualifying charity. Once you hit 73, that transfer counts towards your RMD, but it never shows up as taxable income. It doesn't hit your adjusted gross income at all. That matters more than it might sound. Your AGI in retirement it's not just a tax number, it's the number that determines your Medicare premiums through IRA, how much of your Social Security is taxable, and your eligibility for various other deductions. A qualified charitable distribution lets you satisfy part of your RMD while keeping that all under your control. A concrete example, say your RMD is $40,000 and you normally give $10,000 to your church or to a charity that you care about. If you take the full RMD and then write a check, you've got $40,000 of taxable income and possibly a $10,000 deduction if you itemize. But if you direct that $10,000 straight from your IRA as a qualified charitable distribution, your taxable income is $30,000. No itemizing required. And that $10,000 reduction in AGI might keep you below that IRA threshold, saving even additional money in Medicare premiums year after year. What if tax rates come down? One thing worth addressing. Some people hear all of this and they wonder whether accelerating taxes now makes sense if tax rates might come down. Now, it's a fair question, and an honest answer is nobody knows what Congress will do. In many situations, reducing pre-tax balances while you control the timing and the amount can create more flexibility than just waiting until distributions are forced upon you. The legacy angle. What you leave behind. There's also the question of heirs. Most people assume leaving a large IRA is a gift. Under the Secure Act, most non-spouse beneficiaries now have to empty inherited IRAs within 10 years, often during their own peak earning years, right when they're already in high brackets. A traditional IRA inheritance can become a significant tax problem for your kids. Roth money they inherit can generally be withdrawn tax-free and distributed over a 10-year period required under current rules. Converting isn't just about your tax bill, it changes what you're actually leaving behind. The window here is real and it's finite. Between retirement and age 73, you have more control over your tax situation than you will at any other point in retirement. These strategies, the conversions, early withdrawals, charitable distributions, all work better the earlier you start. And they become harder or even impossible once RMDs are already running. Whether any of them make sense for your situation depends on your numbers, your brackets, and really what you're trying to accomplish. If you want to work through that before that window closes, the link below will get you on my calendar. See you in the next one.